Hello everyone, hope everyone's well. Thank you for joining us for this webinar. You've obviously got nothing better to do with your Tuesday lunchtime other than listen to all things about professional indemnity insurance, but it could be worse because we have to do it all day. So there we go. So welcome. What we'll do, I think we'll just jump straight into it. We've only got an hour, I think, or was it even actually 45 minutes, but Jess and I will intend to talk for 30 minutes and then we'll allow 15 minutes for questions after the end. If you do put any questions into the question box, I'm told...
chat box.
Sorry, Jess.
Sorry.
Chat box. Apologies, chat box. I'm told that the copy of these slides will be issued to you and they will also appear on the dedicated YouTube channel as well. Our details are on this presentation, so of course if you have any further questions, please do feel free to get in touch directly. So if we move on with introductions very quickly. So we are Lockton. We are the world's largest independent insurance broker. We act in the UK, specialising in professional indemnity insurance across our 4 main hubs, being London, Bristol, Manchester and Edinburgh. My name is David Isherwood. As you can tell from my accent, I am from Liverpool originally, and I've been with Lockton for 13 years. I specialise in construction, professional indemnity insurance, and I'm joined by my excellent colleague, Jess Snowdon.
Thank you, David. Yeah, my name's Jess Snowdon. As David's just introduced, I've been at Lockton now for 11.5 years, dealing in professional indemnity insurance for over 17 years, and mainly specialising in the construction industry now, which, yeah, has its fun. So we're going to talk to you today about what professional indemnity is, what the current markets are, conditions are, what we're seeing, and then David's going to take over and talk about cladding and the fire safety, which is obviously quite a key topic at the minute, and then impact on any new legislation. And then what we can do for renewal and looking ahead if we had a crystal ball. We will have Q&A at the end, so feel free to, as David said, just to put your questions in the chat box, and then we'll answer those all at the end, well, as many as we can when we've got time. So what is professional indemnity insurance? It indemnifies the insured against a claim being made or alleged to have been made for financial loss suffered by the third party. This is due to the insured's professional service. So if you have a claim, you did some service, some professional services, and you were alleged to have been negligent, or you were negligent because you'd made financial loss caused to the third party, that is what professional indemnity is mainly there for. It can be a direct loss, or it can be a consequential loss, so suffered by a third party. So it doesn't have to be a direct impact. It can be just as a consequence too. It's also, and I think this is one of the main parts actually for me, and one of the more important ones, is it's there to help defend you in a claim, whether you were negligent or not negligent. It is there to help you defend. So they are the experts that help you, and they will be there to support you, but also to pay those costs as well. As you can probably imagine, the legal expenses costs that solicitors charge are very expensive, and actually can be more expensive than claims sometimes. So yeah, so that's one of the key factors for me actually. Professional indemnity insurance works quite differently from other insurances, so it's on what we call a claims made basis. So it's a policy in force at the time that you're notified of a claim that would respond, not when you undertook the work. So say, for example, you undertook some work 5 years ago and received a claim today, it would be the policy in force today that would respond. So when we're looking at covers and renewal side of it, we need to make sure that we are having the covers for any historical work that you might have done as well. So it does work differently to quite a few other insurances in that way. Who buys it? Generally, anybody who gives professional services and provides advice, design, So most architects, engineers, solicitors, accountants, I mean the list goes on and on and on, but there's a lot of people that require it for the work that they do. Some of them it is mandatory, so if you're a member of certain associations, so the SRA if you're a solicitor, ARB for architects, RICS for surveyors, they will require you to have it to be a member of their association, and they also have minimum requirements as well, so you can't just have the cover, you have to make sure you meet their specific requirements as well. Oh, sorry, my slide's not going on. There you go. Okay, why would a PI claim arise? It could just be as simple as allegation of wrongdoing in the services that you've provided. So you've made an error, that kind of thing. And again, with design and specification, it could just be that you have designed something incorrectly, or it's not done what it was meant to do, or as the job specification required. It could be due to late delivery. So if things, as we all know, especially in the construction industry, most projects are delayed for one reason or another. When they are delayed, it means that they have got a financial loss because they're not up and running as quickly as they wanted to. They're having more costs for the fact that it's been delayed. So we see quite a few claims on that one. It could just be that the building isn't safe. And therefore they've got to do more work, or they've got to make sure it's been signed off, and that's been again delayed for another reason. So that's another potential issue. And it could just be other generic issues that cause it. I mean, we see weird and wonderful claims, and we see a lot of claims, so there's quite a lot of different ones. One of the other ones, which is quite important to note as well, a lot of our clients will use subcontractors and subconsultants. They make errors, it falls on your PI first. It will eventually go to theirs, as provided they've got the correct cover in place. But that's also something that we need to know as well. So the vicarious liability that we see from others that are working on behalf of you as a company. So on to the market cycle, which I think you probably all want to hear about at the minute because it affects your premiums. So the professional, or actually every single insurance market, actually, that it goes in a cycle. So you go from the soft market to the hard market, back to the soft market, back to the hard market. It just keeps going around. Basically, in the soft market is where we see a lot of insurers coming into play. There's a lot more cheaper premiums, wider cover, competition within insurers, so it makes it really good. The problem with the soft market is every insurer is competing against them, which is driving the premium down. The premium that goes down too much, it then means that as soon as there's a claim, not just with you, with the whole BERC, they haven't got enough money in there to pay the pot, which means we then go back to hard market because the insurers are having to recoup and get their pot built back up so that they can pay the claims. So it is very important that whilst premiums sometimes are not what we want them to be, it is so that the insurers can actually pay claims, which ultimately is why we pay the premium in the first place. So hope that all makes sense. And then we'll go to the current market conditions, which we have very much transitioned from a hard market to a soft market. It's still softening and it's still changing at the minute. Maybe a bit too quickly in some people's views, but we'll see what happens there. The insurers are very hungry for premium at the minute, and so they are being very competitive. We are seeing rate decreases, which are becoming common. I would want to caveat that not everybody is getting rate decreases, so it very much depends on the risk, your claims experience, what your exposure is, and so forth. So it does very much depend on that side, but as a whole we are seeing rate decreases. We are seeing new entrants into the market. MGAs, what we like to call is managing general agents, so they sit in between a broker and an insurer basically, and they write on behalf of the insurers. So the capacity is the insurer, so they're the one that pays the claim, but the MGAs are the ones that write it, and we are seeing a lot of those coming into the market at the minute. Insurers are getting better returns on the investment, which does mean that their pot is getting bigger, which does help also drive the premium down because they are getting more income from that side of it as well. So that certainly does help. And then obviously a lot of you have seen about the cladding and the fire, which David will touch on more in a minute, but the notifications have actually crystallized. So a lot of the reservations that insurers had previously, especially with the premium side, just in case, because they've crystallized, it means that they don't necessarily need to worry as much, still a little bit, but not as much as they had to before. Okay. So what are we seeing in the PI market? So as I said a minute ago, premium reductions for the right risks. Again, it does very much depend on your risk profile. You can't compare company to company because it is very, very different. Rating decreases for those with increased fee incomes. So if your fee income has increased, we are still seeing rate decreases, which is nice to see, again, for the right risks. Or not wrong risks, but you know what I mean. Insurers, as I said, competition is fierce at the minute, and insurers are trying to throw everything at these risks to try and win them. They have got high targets and they're doing everything they can to get them. So we're also seeing increased line sizes. So if you've got co-insurance or different layers, they are starting to be able to write more than what they had before. So for example, if you've got you hold a 5 million limit and you've got at the minute a primary 2 million and a excess layer of 3 million, we are now seeing some insurers writing 5 million, for example. Again, right risks and certain things, but yeah. We're also seeing, whereas before we had aggregate basis and aggregate unlimited round-the-clock reinstatements, which David will explain in a minute, we're now seeing that change a little bit more to any one claim, which is offering wider cover. So that's a good thing to see as well. David, over to you.
Thanks, Jess. So, as Jess alludes to, there are different structures to the professional indemnity insurance policy. I'll take us back ever so slightly. When we talk about the hard market, we saw a lot of insurers for certain risks restrict the cover to aggregates away from the old any one claim nature of cover. However, you know, as a lot of consultants, yes, notably engineers, architects, surveyors, required a form of any one claim cover, which is where we saw more and more this third option come about. So any one claim and in the aggregate plus unlimited round-the-clock reinstatements. It does get slightly confusing. I personally think that depending on your own experience, I realise a lot of people on this call are going to have different backgrounds in terms of, you know, where they come from, how much they know about professional indemnity insurance. So, you know, I don't want to dwell on this point perhaps too much because it may be irrelevant for some, but I do think there's a lot of confusion around this. So just to very quickly summarise, you can have any one claim cover. Yep, you can have 100 claims in any year. Each one is covered to your full limit and you effectively insurer's liability is unlimited. You can have option number 2, which is in the aggregate. You've got an aggregate limit for the collection, the sum of all claims for your policy year. Or a third option, or any one claim and aggregate plus unlimited round-the-clock reinstatement model. You may find that a lot of contractors have that third model in place, and you may also find, depending on who you work with, some of the larger consultants have that model in place because it works better for the insurers, as we have demonstrated in this very exciting diagram. So as you can see here, the any one claim model versus the aggregate round-the-clock RTC reinstatement model differs. In your any one claim model, the claim goes up the tower each time, and your primary insurer is going to pay for that claim each and every time. In your aggregate unlimited reinstatement model, effectively it has to go all the way up the tower before coming back around and reinstating. So effectively the tower reinstates once the full limit has been burnt out and for any new claim. The reason that we have that second way of buying professional indemnity insurance, this aggregate reinstatement model, is because as far as insurers are concerned, it is a bit better for them. So if you think if you're insurer A on that model, Under the any one claim model, you're going to pay that first £5 million each and every time. So in that scenario whereby you have 10 claims, let's say in a policy year, you'd be very unlucky, but if it were to happen, your primary insurer, you are going to pay the £5 million on each and every one of those claims. Under your aggregate reinstatement model, if you're insurer A, you'll pay the first £5 million, but then for the next £5 million claim, it will move to insurer B, who's sitting on top of you. And that's why insurers would prefer that option. I would say for the buyers of professional indemnity insurance on this call, if you haven't already, and if you have struggled with your PI premiums or insurers, actually, that model might suit you in terms of how it operates and in terms of the cover that you're required to buy. So it is just something to bear in mind that where you see that written, it basically means any one claim. It's just a different operation behind the scenes. So we are going to move on to the cladding and fire safety cover available under professional indemnity insurance. You may well be aware that as a result of the Grenfell tragedy, insurers did start to restrict cover quite significantly back from 2017 onwards, I would suggest, noting that the professional indemnity insurance market is by its very nature reactionary as opposed to proactive. We did see some exclusions for all things to do with cladding and fire safety coming in, I would say, from 2017-ish. It became a bit more involved, 2018, 2019. It actually took until 2021 that I think we had some standardization amongst clauses for our insurers when we talk about giving cladding and fire safety cover. The International Underwriting Association, so the IUA, sought to provide conformity, and we did have what we would consider a standard boilerplate clause that applies to, or applied at that point, I would say, to a number of professional indemnity insurance policies. Some still had exclusions on them, and that it was very much a risk-dependent analysis, but we would say that the IUA clause at that point was the broadest cover that was available. The cover was basically, in the aggregate, it was for negligence only, rectification costs, and it excluded things like consequential damages. So for instance, the cost of decamping or dehousing. Again, that Grenfell scenario was what insurers were trying to manage and trying to actively remove some cover for, i.e. the cost of people moving homes while the building was being reclad. As we sit here today, and to Jess's point, the market's softening, so that's good. Not only do premiums come down, rates come down, actually cover broadens, and with that, we're seeing slowly but surely cladding and fire safety improve, and in some cases improve even in addition, I say away from it, in addition perhaps is the better word, in terms of coverage. If you had the IUA clause before, actually in certain scenarios it's possible to get more cover than that on a go forward basis. For those that had exclusions before, we're seeing the walls come down a bit and insurers perhaps be a bit more lenient. So it's worth having that conversation with your broker if you haven't already done so in terms of what cover is available for cladding and fire safety. There are some other things to mention, which is impact of new legislation. The Building Safety Act, of course, came into play in 2022. The ramifications of that are yet to be seen, and realistically, I don't think we'll see them for a few years as and when or if claims start to materialise as a result of the Building Safety Act. You will see, insurers look at that on a case-by-case basis, again, touching on my point about them being reactionary rather than proactive. So I would keep a watching eye on that. The Defective Premises Act is interesting because the Defective Premises Act introduced a 30-year retrospective liability period, whereas before under a deed, effectively you would have 12 years, potentially plus 3 for a stopgap, for an additional period which take you to 15. So without getting too technical about it, because I don't understand, because I'm not a solicitor, that 30-year period is an additional 15 years for a lot of consultants and contractors. We've already seen a couple of claims being notified via the Defective Premises Act. Personally, the most interesting one that I've seen takes us back to 2006, whereby the insured worked on a particular building in 2006 and has had a claim as a result of that work today, again, you know, I would say that under a standard deed with a time limitation period of 12 years after practical completion, that claim would be time barred, but because of the Defective Premises Act, that means that that claim is valid. That one is actually worth about £10 million at this stage. So again, it's not a very nice situation for the insured, but just to prove it does happen. The last point in that slide is, yeah, we are, as I say, we're just looking at the future. I think with these things, insurers may take a view on that if we see more claims, but for now, they will be very much taking a watching brief on those new legislation. Excuse me. So in terms of where we are today and how you can get the best results at renewal, we do appreciate that for most firms, professional indemnity insurance is the second biggest expenditure after your staff wage roll. Depending on claims, it might be more for some, but you know, with a view to that, there is a way that you can get the best results, and that means in terms of premium, in terms of rates, in terms of coverage. It isn't rocket science. I think a lot of this is quite basic, but they are actually quite important points. We would always say to get the renewal info early. I think that's rule number one. I put ideally 6 weeks there. You know, I realise people have got other stuff to do, right, rather than filling out bureaucratic forms. One of the things that we have introduced at Lockton is an online portal, which I think helps our insureds able to submit their renewal information a bit quicker because it's done online and it captures your information from last year, so hopefully makes that process a bit smoother for you. The reason we say 6 weeks, that gives us time to negotiate with insurers and actually negotiate with a sufficiently large range of insurers for you and on your behalf. We often get questions back from insurers, so again, that 6 week timeline, you know, by the time we get terms, discuss them with you, and you know, talk about where you want to go in terms of cover, it does give us that time. Highlighting aims, objectives, you know, do you want cladding and fire safety cover? Are we looking at a larger excess, lower excess? Do we want to remarket? All of these things are important and I think should be discussed with your broker in advance of renewal. If you can meet with your insurer, we would always suggest that that's definitely a worthwhile exercise. Not always possible, but you know, even if the team's call, so sometimes, you know, underwriters, and we've got a few underwriters on this call, but you know, they are human beings at the end of the day, and I think it does no harm to meet them and just to discuss it in an open forum. Talking about how you do limit your own liability in terms of contracts, what are you doing about consequential losses, financial caps in your own contracts, anything that you can say to your insurer via your broker to promote yourself as a very good risk, that's going to help. Your contracts are the key thing here. So if you can talk about how you limit your own liability and indeed how you vet or manage your supply chain, if there is one, in terms of subconsultants, that is going to be really, really valuable. Anything else to do with risk management is important, of course. How do you vet your clients? You know, how do you ensure you're getting paid? Certain practices will have their internal procedures, you know, before they start on any particular project about looking, you know, how they work. I think some of the, well, perhaps, you know, the most common cause of claim we see actually probably is our insureds not necessarily knowing their clients, and I think it is an important point to know your client, know who you're, for want of a better phrase, getting into bed with. I think that is important just to be aware of that. And if you have had claims, they happen, right? And that's what professional indemnity insurance is there for. Being able to talk about them with your insurer and why they won't happen again, or what steps you've taken to mitigate future losses from the same type of issue, is going to be really important as well. So just looking ahead, we don't really know what's going to happen, and that's a bit of a cop-out, isn't it, from an insurance broker, but it's very true. We don't know what's going to happen. You know, if we look back at the hard market, yes, okay, there were signs that the hard market was going to come forward, but no one could have seen the Grenfell incident and the impact that that had on the future. The Building Safety Act and the Defective Premises Act, whilst we can crystal ball gaze, I think that that's going to take a few years for insurers to really crystallise their views on it, and it to have that knock-on effect into professional indemnity insurance and what that means for buyers. That is going to take some time in terms of coming through. We mentioned the Dagenham issue recently. Was that 3 weeks ago now? I can't remember. Time flies. that actually could be an interesting one. It may be that when the facts are considered, that actually insurers reassess some of the cover that they are giving for cladding and fire safety under professional indemnity insurance policies. That suggests that the risk is still there. I know that particular building was being reclad at the time, but there's perhaps a bit of a question mark about what will happen there. If you then tie that in with the very recent Grenfell report, for anyone that's read it, again, these things may well have a knock-on effect onto the professional indemnity insurance market and actually the construction industry as a whole. But a lot of these things are watching briefs, I think, as far as we are concerned. Excuse me, I'm still recovering from the time. So I think that brings us to the end of our presentation. I said we'd try to stick to half an hour, so that we have.
We've done well there.
That's good. We've done all right there. As we said, you can type questions into the box. I can see one question. Oh, I can see a couple of questions. Bear with me.
Oh, I've not got any questions.
Okay. So I think the need to make this box slightly bigger. Bear with. Here we go. So do all PI products cover historic work? Are there limits to this? For example, 10 years, question from Rebecca. So the short answer, Rebecca, is yes, ideally. Professional indemnity insurance is written on a claims made basis, so it's the cover that you have in force at the time a claim is notified against you. It's today's cover that would ideally cover you for all of your past liabilities. We couldn't say all PI products cover you for the past 10 years because you would have to implicitly state on your proposal form and via your broker that you require cover for the last 10 years. But I suppose what we would say is that it is very common, and I would suggest that all of our insureds buy professional indemnity insurance for all of their historic liabilities, and that is absolutely the way it should be, because that is how professional indemnity insurance is supposed to work. I think adding to that, any contracts that you sign will obligate you realistically to carry professional indemnity insurance for 6 if it's signed underhand, or 12 years if it's under a deed. So again, you'll probably have that obligation by historic contracts that you've signed. But certainly at common law, the liability period is 12 years, and therefore, yeah, your PI should marry up to that and cover you for the past liabilities. So the short answer is they should do.
I still can't see the questions.
Oh, okay, sorry. Rebecca said thank you, so there you go. Rebecca, you'll be pleased to hear that you're the only actual person that's asked a question, so that means it must have been that informative, yes.
Yeah, that's what I think. Oh, we sent everyone off to sleep.
Will the slides be shared after the meeting? Yes. So
they will.
They will be shared, yeah, and I believe it will be on the YouTube channel as well. Yeah. So there you go. And again, apologies if you can't understand my accent. I can't do much about that. So we have another question here, so just bear with me while I read it. So I'm in no way an insurance expert. That's okay, Mark, neither am I. But what happens if a contractor has run-off cover but goes insolvent during that period? Can the client still claim from the insurer? Oh, that's a good one.
It is a good one.
Wow, so good question. So okay, so run-off cover, for those that you don't know, just so we're clear, I suppose. So if you stop trading, you can buy run-off cover, and run-off cover is just professional indemnity insurance cover, and it covers you for all past liabilities. So yeah, if a contractor, I know that you said contractor there, you're suggesting that a contractor is more likely to go insolvent, and you're unfortunately right. If a contractor buys run-off cover, it's an annual policy, so it's only valid for 12 months, okay, potentially 18 months, then it renews. If they go insolvent in the course of that, then actually it would be the job of the liquidators to maintain that run-off cover, or the individuals, the ex-directors, the ex-partners, whoever it may be. The point is, someone has to maintain that policy going forward. So that's the first thing. I have seen it, Mark, and it does happen. You won't be surprised to hear this, that, do you know what? It's not always that high on the list of priorities. And of course, someone's got to fund it because there's still a premium due for the runoff cover. Yes, it's less than what they would have paid when they were in business, but there is still a premium due. So it happens whereby, yes, they've gone insolvent, they maintain runoff cover for a couple of years, and then maybe they chance their arm, or the people are around to do it anymore, or they lose contact with the broker, whatever it may be, and they don't renew it. If they don't renew it, there's no cover there for past liabilities. So going into your second question, this is where it gets complicated, and I'm going to caveat this, and this has to make the recording for anyone that's listening. We're not legal. We're not solicitors, not giving legal advice, but I understand that there is an act called the Third Party Rights Against Insurers Act. In theory, if the cover is still there, so again, they would have had, someone would have had to have renewed it, you can claim against the insurers directly, but there still has to be a valid policy of insurance. So maybe this doesn't quite relate. I have seen it whereby a claim was notified under Indeed runoff policy. The people dealing with the policy weren't around anymore. Again, it was a contractor actually that went into liquidation. The claimant basically brought that claim against the insurers direct instead of going via the contractor because there was no one there. So in theory, yes, but the policy has to be there. You can make a claim against the insurers direct because there's something called the Third Party Rights Against Insurers Act, but there has to be a policy of insurance there for that to be activated. So it happens a lot, to be honest, but ultimately the contractor / consultant, whoever it may be, still actually needs to purchase runoff cover and renew it each year. So is there any other questions to go in the box? Again, on the slides we'll have our details, so there's absolutely no problem if you want to email Jess and I directly, or take it up with your representative from the CICES. I'll give it a minute or so, just if anyone wants to type any more questions. Okay, I don't think there's necessarily any more. I've got a few thank yous in the group, and people sending a drop off. I've realised people want to go and get lunch, so just like me. So I think we'll close. Yes, I guess.
Absolutely. Thank you so much for your time, everyone. Don't forget to log your CPD hours.
Yeah, of course, most important. Yeah, thank you very much for joining.
Absolutely, thank you. And yeah, feel free to give us a call or email if you need anything.
Yeah.
Thanks.
Thank you, everyone.